Hi, debt is an important parameter for fundamental analysis, right? We distinguish between companies with high debt and low debt. We try to figure out which companies have increased their debt level and who has reduced their debt level. So, what is the impact on the prices? I have actually performed a comprehensive study using little bit of uh, codes and little bit of AI using some statistical tools, and that resulted a very interesting fact in front of us. Hi, this is Anik Mitra. I am a semi-registered research analyst part-time, having my registration number INH 0000 My disclaimer is I do not have any buy sell hold recommendation through this particular video. My discussion in this particular video is absolutely for academic purpose only. So let me unleash whatever we've got in from this particular study. So I distinguished the entire study into two hubs. Acha, before that, it is important to tell you the entire study was done on the basis of FY26 result. So March 26 result. From March 26 result, we get to know what was the debt level of FY26, and we compared it with FY25 debt level. So this full year FY25 and FY26 difference in the debt level was captured, right? And we got around 2000 stocks of that kind where either debt has been reduced or debt has been increased, and simultaneously where stock prices have also either increased or decreased. So that type of around 2000 stocks we have found out of the entire listed gamut of more than 5000 stocks in this particular time frame I did mention. So out of that 2000 stocks, what was the performance? I actually took a 3 months return, means which started from mid of May to mid of August. So why mid of May? Because we usually start getting result from beginning of April, and by mid of May all the results are almost over. So I have chosen this 3 months from mid of May to mid of August for understanding the return scenario. And parallelly, I did a 6 months price performance as well, which started from mid of March to mid of August. So why mid of March? Because result was about to come. I just tried to capture if on the basis of expectation it has been factored in. So now let me tell you about the result. The result is I distinguished the entire study result into two hubs. One is companies where debt has been reduced by more than 50%. Another half is debt increased by more than 50%. So companies where debt reduced by more than 50%, there 64% of the stocks under our study resulted positive return, and 36% of the stocks resulted less than yes 36% of the stocks had negative return when where debt has been reduced by more than 50%. Companies where debt has been increased by more than 50%, 72.6% stocks of our study resulted has shown positive return. 72.6% of the companies where debt has been increased by more than 50%, there 72.6% stocks of our study generated positive return, and 27.4% stocks generated negative return. So, for the companies where debt has been reduced by more than 50%, there, if we distinguished in a few slabs, then we will find that companies tend to company 12.8% companies generated 0 to 10% return. Uh, Another 12.8% stocks generated 10 to 20% return. Another 30% stocks generated 20 to 30% return. Around 25.6% stocks generated more than 30% return. And whenever prices fell, uh, what I said, 36% stocks generated negative return. Uh, Among that, 12.8% stocks fell 0 to 10%. Another around 13% stocks fell between 10 to 20%. And another 10.3% stocks fell more than 30%. And as far as debt increase is concerned, 50 more than by more than 50%, where debt has been increased. 35.3% stocks generated more than 30% return. 11.8% stocks generated 20 to 30% return. 13.7% stocks generated 10 to 20% return, and another 11.8% stocks generated 0 to 10% return. And as far as negative return is concerned, for this category where debt increased by 50 more than 50%, 27.4% stocks generated negative return. Out of that, 11.8% fell 10 to 0 to 10%. 22 as 10 to 20% return generated 10 to 20% companies which fail 10 to 20%, that was 7.8% companies fail 10 to 20%, and another 7.8% companies fail more than 30%. Now, in absolute term, I have tried to find out the performance. Companies with more than 100 crore of debt, uh, their average return was around 6.2% in the 3 months, and average 6 months return was around 11.8%. Companies where debt level is at the medium debt is at the medium level, 10 to 100 crore, there 16.8% return generated in 3 months, and average, that is the average return I'm referring to, and average 6 months return was 34.5%. And companies with low debt less than 1 crore, they are 11.8%, sorry, 18.5% return was generated by average return was generated, and in 6 months 38.1% average return was generated. So what is the what is the conclusion? Conclusion is companies where debt has been significantly reduced had no consistent pattern of outperformance. So on the basis of debt reduction, it's very risky to take a call because result was very random. So that's it in this particular video. I hope you have found this video informative, and if you really find this video informative, don't forget to like the video. Don't forget to subscribe the channel for getting this type of interesting study and updates, and please subscribe the channel for more support. Thank you so much for your valuation. Thank you so much for your valuable time. See you in the very next video. Thank you.